Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is May 30th, 2024, and today we're going to look at a drop in oil sets a fire for this utility and energy play. Looking at crude today, we actually had a pretty decent sell-off. So crude spiked up yesterday, hitting a high of 80.62 as far as the futures are concerned, and sold off and erased the bullish day that we had 2 days earlier. Now that sell-off is not enough to break us out, but it's definitely enough to erase this expansion and pull us back down and push us bearishly towards the lows. Now there's an opposite or inverse correlation between crude, energy prices, and utilities, generally speaking. Because if energy prices are low, such as natural gas, then we can produce more electrical utilities for cheaper costs. And so crude selling off, possibly breaking through its support level, and this support level has been a very strong barrier going all the way back into February. If this is the breakout, then crude and natural gas will likely continue to slide. The utility companies will be able to pay less money, have higher margins, and the energy sectors are going to struggle as well. In fact, we can see some of that data from the Energy Department, EIA.gov. And in the short-term energy outlook, looking specifically at OPEC and its ability to produce more oil, the surplus crude oil production capacity, meaning the ability to produce more than we need based on its 2014 to 2023 average. 2023, 2024, and 2025, despite all the uncertainty, it's estimated that they could produce an additional 4+ million barrels per day all the way through 2025. And that means we have the ability, or the surplus supply and the ability to deliver a very large amount of oil production just from OPEC. That doesn't count all the other producers of oil or the U.S.'s ability to produce from the Permian Basin and other areas. So we have an excess supply that we're not tapping into, and oil prices are falling despite the fact that we're not even accessing this. If we do access this, then we really could see a continuation lower. Now we take a look at the outlook as far as prices go, and we're pretty evenly divided as far as the standard deviation, the curve, or the 95% expect. So it's about 2 standard deviations of confidence. Interval lower bound is about $40 a barrel, and upper bound is about $130. So with this push lower and our current price being about 82, we're priced about mid-price, but notice that the futures price is pricing lower and lower and lower into 2025. And we're talking about maybe $7-8 move, another 10% drop. And that would bring oil prices, as far as crude futures, back all the way down to 70. If we look at the correlation, specifically the correlation utility versus crude, you'll see the majority of time we have an inverse correlation. In fact, as crude over the 10-year weekly chart, once a week kind of updates, we're currently at an inverse correlation of 87%. Now there's times that we pop up and drop back down. Negative 87, in other words, an 87% inverse correlation between utilities and crude. And even though there's these spikes up here, they're temporary, and we spend about 60% of the time inversely correlated, not positively correlated, with utilities versus crude. But because of that, if crude prices are falling and going to continue to fall, then we're going to expect utilities to gain more, have higher margins, while we also expect the energy sector to suffer. And today, I'm not going to dig a lot into the fundamentals and what money they have, or the cash flow, or even the book ratios or quick ratios, any of that. We're just going to focus purely off a technical view that if oil is selling off and at or breaking through its support, then who is going to sell off quicker, or who is selling off quicker? And we can see that ConocoPhillips and Valero are 2 big companies that have a pretty bright red color today. That means they're selling off. If oil is selling off, let's take a look at Conoco and Valero. Jumping over back to the charts. Here's ConocoPhillips. You can see we broke out yesterday and continued today. So we made lower highs, lower lows, lower highs, lower lows. And we've continued that trend. It looks like we should go back and at least retest 111, but it looks to me like we have the capacity to run all the way down to 106. And if we're looking for a move to 106, we're talking about only about $7 in that move, which is about 7%. Now, that doesn't mean that we want to just play that for 7% move. There are some option trades that we could take a look at. And if you look at the current implied volatility percentile, It's at 49%. That's a decent payment right there, no matter whether I'm looking at, if I'm here, we're pricing in higher volatility than normal. And this is where I want to be a short option seller, meaning I want to be selling call spreads or put spreads. And since we're looking to be bearish, we want to look out to sell call spreads. Now I have the 1 month, regular month expiration here. I generally don't sell deltas that tight or that high to the at the money price. So I would go out to the 42. That's generally the maximum I want to sell. Buy the one strike out, and that's 38 cents. So 38 cents reward versus 62-cent risk. That is a good reward risk ratio for that probability. That is a 62% return on risk. It is a premium that pays us that we need to be right 62% of the time, and it says we're not going to be wrong 64% of the time. And again, we're in right about that realm. There's a tiny bit of edge in there. So let's go take a look at Valero. Valero broke support today. That was a clean break. It's probably the best looking chart that I found as far as on energy. That's a nice breakout. It was in conjunction with the dividend, but with a nice breakout, we broke below the low. And the next target for me is 143. But realistically, I think we're going back to 135. So we have a bigger dollar move. We're looking to drop about $16, $17, which means we're looking for about 11% drop instead of 7% drop. So Valero has a better opportunity as far as directional price action. Looking at the options, we go to the trade tab again. Scrolling down. We look at our implied volatility, and again, we are at a high percent implied volatility, in fact, higher than what we just saw in Conoco. So looking at the same options, same monthly strike, if we sell the 39 at 155 and buy the next strike out, same short call vertical, we're trying to collect premium on this. This one is going to give us 81 cents. Now we need 25 cents per dollar wide spread. This is not a dollar wide spread like we saw in Conoco. It is 250 wide. We're risking $1.70 to make 80 cents. The return on risk is about 50%, but our probabilities are higher. We're going to be right 61% of the time. We're going to be wrong less than 31% of the time. So in other words, we're going to be not wrong 69% of the time. So a higher probability trade, a decent premium at 81 cents, and it might be an opportunity to do both. So I like both of these. I want to be an option seller with such high implied volatility percentile. Now, if this is the case, that oil selling off and the energy stocks are starting to fail and slide and break down, I want to look for the opportunity to trade utilities long. And utilities also will pay us a good dividend. As you can see, in a market today where most of the market was struggling, utilities are all in the green, or at least in a very light shade of green, or if not bright, dark green. And we have electric utilities. That's the one I really want to focus on, because gas prices or oil prices, and therefore natural gas prices, are sliding. And that will mean all the utilities, electric utilities that use natural gas to run their utilities, are going to have the better margins and the better opportunity. So looking at the big ones again, let's look at Nextera. And this one is pushing right up to break out through its new highs. It doesn't give us a lot of price pattern to work with, but it is approaching a 52-week high. There's a dividend payment coming up, so if we can be in the long stock, that would be better to collect that dividend payment. But as we're breaking higher, even as we speak, we're moving higher towards that 52-week high. 52-week high breakouts are generally a good strategy to be able to invest. We could look at the options, and if we're looking at the options, we expect to see lower implied volatility on Nextera than we do on the others, because price is breaking to a new 52-week high. Reality is our current implied volatility is 63%. That means the options are overpriced as we're approaching this 52-week high. So even though I want that dividend, I want to collect premium. So my choice is buy the stock and sell the call if I want to collect the premium, or sell the put to collect that premium. We've shown you this before. Current price, $77.93. So the closest price is the 78. What is the 78 going to pay us for our willingness to buy the stock? if we add that return on risk as a percentile, it'll tell us that that option is going to pay us 3%. We're doing 3% for 22 days or 3 weeks. Now, if we get assigned, that means we're getting assigned and collecting the $2.30 versus 78. That brings our cost 75, what is that? 75.70. So 75.70, would we be willing to buy NextEra at 75.70, especially when it's going to pay us a dividend? That dividend is coming up here in just a couple of weeks, and that dividend is worth about 2.6% yield. Sure. And I think that's a reasonable way to go. We could sell the put and say I'd be willing to buy it here if they drop the price and we don't get assigned or do get assigned. In the end, it's as though we bought it at 75.70. If we're looking at it and saying, nope, I want to collect that dividend, we just want to buy the stock. However, that implied volatility is still high. So what if we were to look out a little bit further and look at this as the breakout potentially, and let's go out to July and let's do an in-out spread. To do this, we'll do the same thing we've done before. We're going to look at a delta near 70, which is the 75. We're going to go in and look at our intrinsic extrinsic. And if I were to buy the 75, that's a 178.50 in extrinsic value. And I'd want to sell out of the money. We're looking to break through a record high. So I could buy the 75 and sell the 80 for a $5 wide spread. It will give me a positive credit as far as time decay is concerned. And that sets us up for a 255, so very similar to the other ones we've seen. It's 1-to-1, but we're positive time decay. However, if you want that dividend, just buy the stock. If you want the premium, sell the put. If you like the in-out spread, it's 1-to-1, but the probabilities are better that you're going to get better than 1-to-1. For our second one to look at in utility, I've looked at Southern, Duke, Xcel. Southern has a 70% implied volatility percentage. Duke and Xcel are about 25 and 30. So if you want to be an option buyer, we're going to look at Duke and Xcel. If you want to be an option seller, we're going to look at Southern. And Southern and Duke and Xcel look better as far as technical setup, even though NextEra is breaking out to record highs. Let's take a quick look. Here's Southern, lovely bounce, nice higher close there. Could be an opportunity to sell premium. 70% implied volatility if you look at the charts, selling 3 weeks worth of premium. If we look at our return on risk again, that is only going to give us about 1.5%. So Southern has a 70% current implied volatility percentile. Very high for the time. The payment's not high enough to make this very attractive to sell a put. That is only 1.5% for selling at the money on Southern. Looks very similar to NextEra. The bounce looks good, but let's take a look at Duke and Xcel. So here's Duke. Great bounce here as well. Old previous support and resistance that are playing out there, but a great little bounce off of that low. Look at the trade percentile, 24%, very inexpensive. So for Duke, low cost premium on a nice bounce probably gives us the opportunity to just buy the stock one or buy the call. We can buy the call. There's not weekly options on Duke, so we'd want to go out at least to June, but probably out to July, and buy the in-the-money call, sell the out-of-the-money call, and participate in this next move higher. I could just buy the call at 64 Delta. It's $3.50. That's the maximum risk we would be taking. And if Duke bounces here, and if we see it just return back up to the highs at 104.60 or even 105 like we just looked at, then that trade goes from an at-the-money 100 for 350 to 105, which would mean we're seeing at least a $5 price, if not more. And if it goes in the money, then we could see that move all the way up to what would be considered maybe 750. So it could be a 100% return on risk on this bounce just by buying the call. The in-out spread is still priced about 250. Xcel has given us a similar bounce. Great little bounce there. Cheaper stock, 30% implied volatility, 31% implied volatility. So again, an opportunity to buy the stock, collect the dividend, 4% dividend, by the way, or simply buy the call. If we buy the call, that delta is not right, but we'd be paying $5.80. That's 10% of the price. But we could buy the 50 and sell the 55 and we'll still be in that trade for about 250. Xcel doesn't have the same implied volatility, so this one's not pricing quite as well. So I'd say we're probably leaning to Duke. And the last thing I'll look at really quickly with you is we could play both sides of it, and that's as a pairs trade. So I'm going to take energy, and energy is trading at $90, the energy sector ETF, and the utilities are trading at about 70, XLU. And if I want to buy utilities and sell energy to fund it, I could create a pairs trade. Now trading at 71, we could take 4 times XLU and subtract out 3 times XLE, and it's going to create a pairs trade that's just above 0. If we continue to see this trend go higher, the move that we already had from just April 1st through April 8th, that first week, we've gone from $35 up to $13. We've seen almost a $50 move. At $13 for a pairs trade, we could see this run another $50 move as we're approaching this breakout. And if we break through here, we could see it reach $63 for this pair. Now, it's not truly investing $13. It is a pairs trade, so you're buying 400 shares of XLU and selling 300 shares of XLE. And that is about $28,000 of margin in that trade, if that's something that you're looking to do as kind of a long-term investment. But you could certainly use the chart as a way to time your trades, and you could buy a call in utilities and buy a put in XLE to create the same pattern. That's going to do it for me today. Have a fantastic week. We'll look forward to talking to you again next Thursday or tomorrow morning at TheoTRADE Live.